All right, everyone. Let's think about a business for a moment. Any business. Every single day, it's just a whirlwind of activity, right? You've got sales being made, you've got invoices coming in, you're buying supplies, you're paying your employees. It's this constant, never-ending stream of financial information, a torrent of data that, if we're being honest, can feel like absolute chaos.
So that brings us to the central question for today. How does a company take that chaotic flood of numbers and transform it into something meaningful? A clear, understandable picture of the company's financial health. How do you find the signal inside all of that noise? Well, the answer, as you'll see, is actually remarkably elegant.
You see, it's not about trying to tackle everything all at once. That's a recipe for disaster. Instead, it's about a methodical, step-by-step system, a repeatable process that brings order to that chaos. It's a cycle that turns all that raw data into powerful, usable insight.
And that process has a name: the accounting cycle. Now, this definition on screen is more than just the definition. It's our roadmap. Let's break it down. Notice those key words. First, it's a sequence. That means the order of these steps is absolutely crucial. You can't just do them in any order you want. Its job is to record, classify, and summarize every single financial event. And all of this happens within a specific period, whether that's a month, a quarter, or a year. This right here is the fundamental blueprint for achieving financial clarity in any organization.
Okay, so let's start where it all begins. The first phase of this cycle is all about capturing the action as it happens. We're talking about turning those raw, real-world business events into structured data that we can actually work with. The first 3 steps really are the foundation of this entire process. Step 1 is simply to identify a transaction. You have to ask, did a financial event occur? Did we sell something? Did we buy something? Was a service performed? That's a transaction. Then, step 2, you immediately record it in what's called a journal. Now, I want you to think of the journal as the business's official diary. It's a chronological log of everything that happens, day by day, in the order it happened. And then, step 3, you post those journal entries to a ledger. This is where the real organization starts to happen. We take those diary entries and we start sorting them into specific categories or accounts, things like cash, sales, or office supplies.
This analogy is genuinely one of the best ways to understand the difference. The journal is the diary. It tells the story of your business in the order that it happened. The ledger, that's the filing cabinet. It takes that story and sorts it neatly by topic. If you want to know what happened on Tuesday, you look at the journal. If you want to know how much you spent on rent all year, you look in the ledger. And the separation is so much more than just good organization. It's an essential internal control. Having that chronological, unchangeable diary and a separate categorized summary creates a crystal clear audit trail. It makes it incredibly difficult for someone to hide a transaction because any number in the ledger has to be traceable back to a specific entry in the journal. It's a simple but really powerful security feature.
So, we've diligently captured all of our data. But that leads to the next crucial question. Is it even correct? This brings us to the second part of our cycle, which is all about verification. You can think of this as the fact-checking phase before we publish the final story.
And this is a really serious question. I mean, after recording hundreds, maybe thousands of individual transactions, human error is almost inevitable. A misplaced decimal point here, a forgotten entry there. How can we be sure that the books are mathematically sound before we start using them to make critical business decisions? Well, the cycle has a 2-part answer. Step 4 is preparing what's called a trial balance. This is a brilliant first-pass check. You simply list all of your accounts and their balances. Now, in double entry accounting, which is the system we use, every transaction has 2 sides, a debit and a credit, that have to be equal. Think of it like a seesaw. The trial balance makes sure that seesaw is perfectly balanced. If your debits don't equal your credits, you know immediately there's a mistake somewhere that you have to find. But here's the tricky part. Even if it is balanced, we're not done. That brings us to step 5, making adjustments. This is for all the financial events that happen over time, not just in a single transaction. For example, a piece of machinery slowly loses value over its life. That's called depreciation, and we need to account for it.
And this is the crucial point I want you to take away. Adjustments are what make our financial reports a true reflection of economic reality. They ensure that we're matching revenues with the expenses used to earn them, even if the cash hasn't actually moved yet. It is the very essence of accrual accounting, and it's what separates simple cash tracking from sophisticated professional financial reporting.
And that brings us to the final act. All of that meticulous work, all the recording, classifying, and verifying, it all leads to this moment, crafting the final story of the company's performance during the period.
This story is told through 3 primary financial statements. The income statement answers the question, were we profitable? It shows your revenues and expenses over the period. The balance sheet gives you a snapshot at a single point in time, answering what does the company own and what does it owe? And finally, the cash flow statement tells you exactly where your cash came from and where it went. Together, these three documents provide a truly comprehensive view of the business.
But here's the thing about a cycle, right? It repeats. The story for this period, say this year, is told, but the business keeps operating. So the final steps aren't just about finishing the reports. They're about resetting the system and getting ready to start the whole process over again for the next period. This is done through a process we call closing the accounts. Specifically, we close what are known as temporary accounts. Your revenues, your expenses, we reset their balances to zero. Why? So you can start the next year with a clean slate. This ensures you can accurately measure next year's performance without it being mixed up with this year's numbers. It's what allows for a fair apples-to-apples comparison period after period.
So, after all that, why do we go through all this trouble? Why does this cycle matter so much? Because, and this is key, the accounting cycle isn't just about tedious bookkeeping. It is a powerful, systematic engine for creating business intelligence.
This journey here is really a value chain of clarity. Think about it. You start with raw, chaotic data points. Those are your transactions. The cycle organizes them into information in the journals and ledgers. Then, it verifies that information with the trial balance and adjustments. And finally, it transforms all of that into actionable intelligence in the form of your financial statements. That's the intelligence you use to make decisions. Ultimately, it all comes back to this simple, powerful idea. The entire process, every single one of these steps, is designed with one goal in mind: to produce clear, reliable summaries that tell you exactly how your company is performing and where it stands financially.
So when you really think about it, the accounting cycle is doing so much more than just counting the money that comes in and the money that goes out.
It takes all those individual, meaningless numbers and weaves them together into a narrative, a story of success, maybe a story of challenges, a story of opportunities. It's the story that any leader, any manager, any investor needs to understand to make smart decisions. So the question I'll leave you with is this: what story are your numbers telling?